Hello everyone, welcome to another episode of Prolete Thoughtcast Numbers and Beyond. Today we are covering the topic business structures. How you set up your startup matters most than most of the founders think. Today I'm joined by our director and principal consultant, Mr. Prem. He's also a startup founder and he has gone through these tranches himself. Very happy to have you, sir. Welcome to the show.
Thanks, Venkat. I'm super excited to be here today. And you're right. The structure you choose for your business is not just for a legal formality, right? It affects everything. How you pay your taxes, how you onboard your co-founders, and how you offer equity, and also how you exit or how you scale up.
Right. I think most of the people here will think that I just need to register a company and get over with it. It's just like a paperwork, and they don't think beyond that, right? So, how do you address this commonly made mistakes by all these founders?
See, even within the private limited companies, right, the setup can be very different.
Okay.
You need to answer certain basic questions before you choose the structure that suits you the best, like whether you want to build a global business or you want to run it like a family business, whether you want to go for external funding or you want to stay bootstrap, whether you are comfortable with all the paperwork and statutory filings or not. These choices clearly define the structure that suits you the best.
Oh, that's nice to know. So, what are the commonly available structures for all the startups? And currently, what are the startup founders looking into in India from your perspective, sir?
Broadly, there are 6 categories, Venkat. Okay. The first one is sole proprietorships.
Okay.
Very simple, very easy to form.
Yeah.
One-man show. But there is no legal distinction between the business owner and the business. Your personal assets are at risk.
Correct.
Right? The second one, partnership firms. Again, it is very similar to proprietorship firms, but you'll have more than one owner.
One owner, yeah.
Yes. But again, here the drawback is the liability is unlimited.
Oh.
And also it is slightly old school.
Right.
Third one, limited liability partnerships. I prefer to call this as sophisticated or dignified partnership firms.
Okay.
The best part is here the liability is limited. You get a liability protection.
So you need not pledge more than what you're actually liable for.
Exactly. Right. It is great for professionals like chartered accountants or company secretaries. That is the reason you see a lot of CA firms, they register under LLC. But it is not great for somebody who is looking to raise funds.
Oh, okay.
Okay. So partnership, proprietorship, and LLP. Fourth one is private limited company. This is a startup favorite, right?
Favorite, yeah.
Because it allows you to issue equity to investors, ESOPs to your employees, and it can also bring in a structure to your operations. Yeah. Fifth one, public limited companies. This is for large businesses, especially for somebody who's looking to go public. Yeah. Or the companies who has large number of shares.
Right.
The last one is OPC, one person company, right? It's slightly weird. It says solo founders. It has its own limitations. That is the reason it is not a preferred choice for a lot of guys. And also it is not suitable for somebody who is planning to raise funds.
Right. Yeah. So can we look into this private limited structure of a company where that's because honestly, that's where a lot of startup action happen. Many people prefer to register their business under private limited scheme. And why do people prefer that? Why is it best when compared to, as you already said, a lot of startup people prefer that? Why is that?
Okay. First point. Because private limited companies offer flexibility and credibility in the market. Okay. Second point, it allows you to offer equity shares to investors or co-founders.
Right.
It allows you to offer ESOPs. And third point, like we all know, private limited companies are governed under Companies Act 2013, right? So there is a layer of legal and regulatory framework. So that is transparency. Trust me, for an investor, this matters a lot, and even to the banks. Fourth point, things like audit, MCA filings, and board meetings, board approvals, all this builds in a habit of compliance. When you hit the scale, you're already well prepared. Okay. And fifth point, if you want to register your startup under Startup India, getting a legal recognition from DPIIT, Department for Promotion of Industry and Internal Trades, is a key step, right? And for you to get this recognition, you need to be a OPC or LLP or private limited company. Okay. Why this recognition matters? because you get to enjoy certain tax exemptions.
Right.
Okay. Your trademark applications will be processed faster.
Okay.
Yeah. And you will have access to government grants. So it is not just a nice to have. It is a strategic move where you're making your startup more investor friendly and compliant right from the word go.
So we get to hear a lot about this founders agreements. So many people don't even consider this in the current era. I just want to know how relevant it is and what is actually the founders agreement.
A founders agreement is like a rule book for the founding team. It basically tells you who does what, who owns how much, and what happens when someone leaves, and also how big decisions are made.
Right.
You mentioned everything in this founders agreement, even the things you think wouldn't matter, wouldn't affect between the founders at a later date, right? Without a proper agreement, you're just relying on the trust. Okay. And trust always gets shaken when things become hard or when you start seeing money.
It's like highly risky when you're just
Exactly. I mean, everything looks good in the beginning, right? When you start seeing money or when things are not going as per the plan, that is when you see there is a need, right? I mean, we need to have a founders agreement. That is when we start talking.
Most of these founders, I think, in current date, don't even give importance to this until they are a year into the business. And I feel that shareholding, important agreements like shareholding agreements, share split agreement, profit split agreements, these are all casually omitted by many of the founders. What risks do you see in that?
Okay. It's a big risk.
Okay.
If your shareholding is not aligned from day one, or if you're promised equity shares to somebody, but you're not documented anything, it explodes later when the investor comes in. I've seen so many cases, Venkat, where two founders verbally agree, that we will have a 50-50 stake in the company. Okay. But nothing is written. 2 years later, one of the founders is doing all the work, right? And the other one, he says, I want to exit the company with my 50% stake. It was chaotic, right? Also, restructuring your company at a later date, right? Like issuing your shares retrospectively is legally messy. It is expensive. And most often, and more importantly, right, it is often questioned by investors during the due diligence.
It takes you off the credibility radar, I believe.
Exactly.
Right. So I think the more the amount of time they wait into getting the agreement, the higher the risk is what I believe.
Absolutely. And another thing, Venkat, the cost of setting things right at the early stage is always like, let's say, if it is going to cost you like few thousand rupees, but fixing it later always costs you lakhs of rupees, but also a lot of legal fees.
Right.
And the worst part is loss of investor confidence.
True.
So that is why I always say structuring is not about legality. It's also about strategic, right? It's a strategic choice. What structure you have to form. It sends a message to your investors and also to your employees that I'm very serious about what I am doing and I am ready.
On this bold note, I think we need to take a break on segment 1. Until then, you need to register and also formulate your policies. And it's very important, if you're watching this, to document everything that the moment you decide upon your ideas and opportunity that you need to pursue. Thank you. So let's talk about funding. This is every startup owner's dream and every founder's dream, maybe. But I think they are always ready, but their company is always not ready, right? And many people actually don't talk about the agreements and the paperwork behind it. They're just not ready. What are your risks? What are the risks and red flags that you see in most of these founders in the early stage with respect to funding, sir?
Okay, so most founders jump into execution method, building, selling, and hiring people, and completely ignore their cap table and legal hygiene. I've seen cases where founders casually promise equity to co-founders, but they never issue any shares or even draft a basic founders agreement.
And when a venture capital shows interest in investing in their firm, they'll all get panicked and they'll see how much stake does he own, how much stake that he own, and what the regulations behind it and all.
Exactly. And that's exactly where the early startups trip. See, investors don't just look at your pitch. They dig into your documentation. They want to know everything. if the shares are issued correctly,
Okay.
if the board approvals are in place,
Mm-hmm.
if your books are clean,
Mm-hmm.
in case of past funding, whether you're compliant with FEMA regulations, in case of foreign investors.
Okay.
So it's going to be a complete audit. It's not like, it's not just a handshake.
Say, for example, I have a friend who's abroad. He's wire transferred me around $20,000.
Mhm.
Does this also bring up like a diligence point? Is there some paperwork that I need to do behind this?
Absolutely.
Oh,
Absolutely.
okay.
See, if it is not routed correctly under the FEMA rules, then you're non-compliant.
Oh,
Okay. So it's not just about legality. It's about signaling. So basically, you're saying that your house is not in order. Okay. So it tells the investors that you are not ready for scale.
So I think it's beyond just paperwork. It's a sign of maturity. I think it shows how responsible you are, right, sir?
Yes, 100% Venkat. When a VC is doing due diligence, they're not just verifying your records, they're evaluating their risk.
Mm-hmm.
If your shareholding is unclear, or if you have any undocumented loans, or if your ESOP pool is undefined, they hesitate.
Oh,
Or worse, sometimes they even ask for a complete restructuring before they invest. And this can delay everything and can derail the deal.
does this happen often, sir?
Way too often, Venkat. Especially with startups who take money informally through friends, families, and relatives and don't document it. Even issuing ESOPs without a proper plan or not registering your company under the right structure can become a blocker. These things are easier to fix early on, and it becomes 10x harder later.
Correct.
Yeah.
So having said how complex it is there a checklist that a founder or a startup owner can look at where it is giving him a cohesive approach to covering all the aspects that he needs to look into before getting funding?
That's a great question, Venkat. At a bare minimum, you need to have the following. First, a properly incorporated private limited company, right? Founders agreement with clear roles, responsibilities of founders. Third one, shareholders agreement, share subscription agreements, and properly issued equity shares. A lot of guys, they say you get 50% stake, but they don't actually print any share certificates, right? In case of past funding, always ensure you're complying with FEMA rules. Always keep your cap table updated and clean,
right?
And proper bookkeeping. Invest in a decent accounting software, right? We have plenty now. And most importantly, do not mix your personal transactions with your business transactions.
Yes, something everyone does.
Exactly.
Right. I think that's a solid list. This also indicates that you are thinking alike with the investor's mindset and perspective.
Exactly. VCs are not just investing in your product, Venkat. They are investing in you as a team and as operators.
Right.
When you have done the groundwork, you are sending a clear message to them saying that I am very serious, I respect your capital, and now I am prepared to scale.
Right.
Yeah.
Thank you so much, sir. So let's talk about the big thing now, foreign holding companies. Where does most of these venture capitalists insist on having a Delaware or Singapore-based institute or an entity?
Great topic, Venkat. Most of founders ask this question to me, especially when they start raising institutional capital. The short answer is VCs want predictability, especially the global VCs. They're not just investing in your product or team, right? They also want to invest in a clean and secure legal framework.
Right.
Places like US or Delaware or Singapore exactly offer that. It's all about investor-friendly mechanisms.
So it's not just about the tax thing that they are getting a benefit out of it.
No, not at all. In fact, that's the most common misconception.
Okay.
People often think it's all about lowering your taxes. But tax is only a small part of the story, right? What matters more is ease of doing business, protection of your shareholder rights, enforcing the contracts, managing exits, and repatriating your capital, right? When a VC invests in Singapore or US-based companies, right, the process is a lot smoother because they have done this 100 times before.
Right.
They know the rules. They know how the courts operate. They trust the jurisdiction.
Right.
If things go wrong, they already have a legal remedy. So it's all about having a clear structure, right? And it's not just about taxes.
So it's about the legal comfort that the VCs are getting, so
Exactly. Imagine you're a VC managing a $500 million fund.
Mhm.
You have investors who have trusted you with their money. Now, your job is to invest it wisely and make sure they earn good returns.
Correct.
Now, when a VC invests in a startup,
Mhm.
even they start thinking, right? How do I get this money back?
True.
Should I be selling my stake? Should I wait for an acquisition? Or should I go for listing? Right? If a VC directly invests in Delaware or Singapore, they know the rules, right? We spoke. They trust the jurisdiction. But if a VC wants to invest directly in an Indian startup, that is when things can become very tricky. Now, suddenly they are dealing with RBI,
Mhm.
FEMA, Companies Act, tax authorities, and many more.
Right.
Even a simple thing like, transferring shares or taking money out of India can take weeks or months, and it needs a lot of approvals.
Right.
And that's a lot of paperwork, right?
Right.
A lot of paperwork, a lot of uncertainties, and a lot of delays. VCs don't like that.
Right.
When the time comes, they want a faster and reliable exit.
Mm.
Places like Delaware and Singapore offer peace of mind.
So when does it actually make sense for a startup to go for the foreign registered entity? And it actually sounds like a costly affair. Is it for everyone? Or do you advise it for every startup that you have to take this move, or who is it actually correct for?
Okay, that's a good question, Venkat. No, definitely it is not worth for everyone. A foreign holding company usually makes sense in 3 specific scenarios.
Okay.
First, if you're planning to raise capital from global investors, right? Especially from VCs in Singapore or USA. Second, if you're planning to hold your IPs in countries with strong IP protection laws.
Okay.
Yeah,
Right.
because India doesn't offer strong IP protection.
Protections, yeah.
And also in countries which offer substantial R&D tax benefits. Even we have, but there are countries which offer like better, tax benefits. Third, if majority of your customers or revenue is from abroad. For example, most Indian SaaS-based companies cater to US market.
Right.
So what they do is they flip the structure. They make the US as a parent and Indian company as a subsidiary or a delivery partner. Delivery center.
So how does the structure actually look like, sir?
Okay. Think of it as a 2-layer setup. You have a foreign company on top, say in Singapore or Delaware. Now this entity owns 100% of your Indian operating company. You may have your product and team sitting in India, but your equity and cap table sits in this foreign entity. Now, when a VC invests money, they don't invest in your Indian operating company. They invest in the holding company.
Right. So this makes it more like Indian entity becoming a fully owned subsidiary of that foreign entity?
Precisely. Yeah.
Right.
Think of it this way. Your Indian entity will be like an execution arm where you hire people, build tech, and serve customers. But your IPs, your board decisions, your shareholding, and your funding, everything stays at the top, at the holding company level.
So I'm guessing this also helps if the startup wants to expand globally beyond just India, right? So this setup.
100%. Let's say you want to expand to Southeast Asia or USA. If your parent company is already in US or Singapore, opening new subsidiaries in other countries can be a lot easier. You don't have to route everything through Indian regulators, which can be very tedious, especially when it comes to cross-border investments or opening new subsidiaries. And also, India has fairly strict rules when it comes to outbound investments. For example, if you try to open a foreign subsidiary from India, then you have RBI permissions, Reserve Bank of India, ODI compliances, and lots of delays.
Right. So I'm assuming this setup also has some downsides.
Definitely.
Right.
It's not always smooth or easy. Right?
Correct.
When you are setting up in 2 different countries, you have to follow rules in both the countries.
Multiple places.
Exactly. So there is more legal work, more tax filings, and more complexities.
Right.
Okay. And there is this transfer pricing. You have to comply with transfer pricing in both the countries. There is dual accounting, RBI formalities, and also audit complexities. You have to do audit in both the countries, whether you have any transactions or you don't have any transactions. Still, audit is mandated. So unless you're very sure about going global in the near future, this structure can be very expensive and also very complex to manage.
Okay, so we have now covered the structural aspect of it, but when actually the money starts moving between Indian entity and the foreign company and the foreign hold entity, where especially in case of outbound investments from India, what are the key frameworks or key paperworks and regulations that a founder actually need to be aware of?
Okay. When you're sending money outside India, for example, paying your parent company for services or repatriating the profits, two major things that needs to be compliant. First one, taxes.
Right.
You need to deduct applicable taxes before making the payment. File Form 15CA, file Form 15CB. 15CB is a certificate from a chartered accountant. We all know that, right?
Right.
The second one is bankers compliance. Bankers will require us to submit invoice copies, declare the RBI purpose code. Right. So it basically says why you're transferring the money. And in some cases, they also insist on underlying agreements or board resolutions, depending upon the severity or the quantum of funds. Yes.
Yeah.
So these are the two things that needs to be compliant. Without these documents, bankers will not process the payment. It will be held for days. Yeah.
What about transfer pricing? I've heard that's another big compliance that we need to ensure.
Yes. Transfer pricing is a part of income tax, first thing. And it is super important. Second point, it applies to all transactions between your Indian entity and related foreign party.
Oh,
that includes your holding company, sister company, subsidiary companies. Third point, it applies to both inward transactions as well as outward transactions. And most important, fourth point, you have to prove that the transaction price is at arm's length. Okay. Meaning that is the price you are willing to pay to an unrelated third party, right? And fifth point, transfer pricing includes maintaining TP documentation. We all have done it, right? You build huge books documenting why we are, what is the basis that we are agreeing on a particular price. Yeah. It also includes filing Form 3CEB, that is your transfer pricing audit report, along with your income tax return.
Right.
And most important, if our income tax department comes back questioning you the logic, you should be ready to defend the logic behind every number. And that is key.
Right. So wrapping up, foreign holding entity, it's a strategical move, not just a financial one, right?
Absolutely. Just be sure about your goals. If you want VC money, if you are looking for an international exit, or if you want to build a global business, structure yourself like a global one right from day one. Otherwise, just stay lean, small, and local.
Yeah. So this is about foreign holding entity segment. Stay tuned for more segments in this episode. So let's talk about ESOPs in this segment, sir. What most of the founders tell their employees, and not everyone actually understand much about ESOPs, right? So what are ESOPs and why is it so much significant in the startup world?
Okay. ESOP is basically a way of giving your team a small ownership in your company. Basically, you're telling them, hey, we build this together, and if we succeed, you get a share in the success. Simple.
Oh, so this is like an alternative for salary, maybe in the earlier terms when you're not able to afford to pay higher salaries to them?
That's only one part of the story, Venkat. In the early days, you may not be able to match big company salaries, but ESOPs helps you attract and retain good talent. You give them a reason to stay and grow with the company.
Okay, understandable. But how does it work actually? Do they get the ESOPs immediately? Is it the share that they get, or how actually does it work in practice?
No. What they get is an option to buy shares at a later date.
Right.
Usually, this is at a fixed price. Okay, and they don't get all options at once. They get it over the course of 3 or 4 years.
Okay.
It is called vesting.
Vesting period. So it's like EMI but for shares.
Yeah, something like that. Usually this is how it is structured. 1 year of cliff. There is no vesting, so they don't get anything. After that, options continue to vest year on year over the course of next 3 or 4 years. So employees earn it bit by bit.
Right. And for the founders, they'll have to plan this whole ESOP thing earlier itself, right, sir?
Yes. Almost all investors ask, have you set aside an ESOP pool? If a founder does not plan this well in advance, they may end up losing their equity. They may end up diluting their equity at a later point of time, and that is not a joke.
Right. So, from an employee's perspective, do they understand what they actually are getting, or how does it typically work with employees?
Okay. Honestly, most employees just see ESOPs in their offer letter and think, okay, that's cool, I'm getting ESOPs. But unless you explain them what it actually means, what happens if they leave the company, what happens if the company gets acquired, it really means nothing. It is just a line on a piece of paper.
So you mean to say the founder has to actually sit down with the employees and explain them how ESOPs works?
Yes, why not? Use your ESOPs to build trust with the employees. You don't have to get into any legal language. Just tell them, if we do well, we have an exit like acquisition, funding, or listing. That is when your ESOPs turn into real money, and that should be the goal. You just tell them this. That's fine.
Right. So any final advice for the founders with respect to ESOP?
Yeah, don't use ESOPs like formality. Use it to build ownership culture amongst the employees. After all, the guys who are sticking with you right from day one, they're also taking a risk, right?
Right.
So give them a stake in your outcome. That's it.
So it's more like don't just give them salary, give them a skin in the game for them.
Absolutely.
All right, sir. We spoke much about business structuring, funding, and also capital structuring and all those terms. But let's be honest, most of the startups owners or the new age business entrepreneurs don't think much about compliance. They tend to ignore the risks around the non-compliance area and all those things. What are your thoughts about it, sir?
You're right, Venkat. Most founders focus on building, selling, and hiring people. A lot of things can take a backseat, especially compliance. But ignoring it can lead to serious issues at a later date, especially during funding rounds or when you're talking to global investors.
So when you say compliance, what exactly do you mean there, sir? Is it just tax and filings?
I like to break this into two parts, Venkat. First one, there is a day-to-day or regular compliance. This include things like GST filing, your GSTR 1, GSTR 3B, 2A, 2B reconciliation, etc. TDS filings, 24Q, 26Q. Then your payroll compliances, which includes your ESI filing, PF filing, PT filing, labor welfare fund filing, etc. And also your regular MCA filings. Even if you're a small startup, you need to follow this. Ignoring them can lead to penalties or even notices. Second one, these are event-based or strategic compliances. This includes stuff like issuing share certificates properly, keeping your board resolutions ready, or having proper agreements with your founders, with your employees, keeping your cap table clean. This may not appear very important as of today, but suddenly one fine day in the future, you will realize the importance, especially during due diligence or during statutory audits.
Right. Okay, sir. Now let's say, for an example, a founder is actually raising funds from one of his friend who's abroad or a VC who's abroad. So what is the compliance measures that he needs to look at or keep in his mind during this transaction?
Okay. This is super important, Venkat, and most often missed by the founders. The moment you receive money from foreign countries to your bank account, FEMA applies. This applies even if you're receiving money from your friends or families or relatives from abroad. The money you received will be treated as foreign direct investment, FDI. You need to follow a specific procedure, such as get a proper valuation certificate by a chartered accountant or a registered valuer for valuing your shares. Issue shares within 60 days from the date of receipt of money into your bank account. File Form FCGPR with RBI. Prepare proper board resolutions and allotment documents.
Right.
And last, always ensure to issue share certificates to your investors. If you skip any of these steps, you'll be considered as non-compliant. RBI may reject your application if you're not filing it on time. You may also end up paying a lot of penalties and fines. And more importantly, it may affect your future investments.
So these compliance is what you said about. Does most of the startup owners and early stage one know about this, huh?
Honestly, most founders don't know this, especially when the investment comes from friends or family or relatives who are staying abroad. They think it is just like any other money bank transfer the moment money is into their bank account. But the government treats this as foreign direct investment. And you need to follow a specific process. If you don't, you may face a lot of difficulties in the future, especially from the government, or you may face issues during your audits or during your funding rounds.
Right. So, what happens when these people know that or they realize that they have missed some of these compliances?
Okay. Usually, most founders panic because they would have received a notice, right?
Right.
They immediately call their chartered accountants or company secretaries, and they will request them to fix things immediately as early as possible. In most cases, it can be fixed.
Right.
Okay. But it takes a lot of time, energy, and also money. I say money because the compounding phase is very significant. That is why it becomes very important to do things correctly at the beginning, and don't wait for others to point it out to you, especially investors during due diligence.
All right, sir. Now, can you give the founders sort of a checklist or an overview for staying on top of this compliance game without losing their mind? Because this all looks very complex at the moment.
Okay. First, create a monthly compliance calendar tracker, okay, or calendar. Track all your regular filings like PF, TDS, ESI, etc. You can use a spreadsheet or you can set reminders on Google Calendar. Second, always keep your cap table clean. Make sure the shares are issued, the share certificates are sent, all board resolutions are properly documented. Third, handle foreign money with care. The moment you expect to receive money from outside India, talk to your CA. Get a valuation certificate if needed, and always ensure that you're following FEMA and RBA rules. Fourth one, maintain a digital record. Store all your filings, board resolution, share certificates, and agreements, which includes your founder agreements, in one place. You can use Google Drive or OneDrive. Trust me, this makes your audits and fundraising a lot smoother.
Awesome, sir. You have made that compliance journey a little bit less scary, I believe. Founders, if you're watching this, go watch your cap table right now. Go have a look at your filings and your inbox. You will thank yourself later. Wow, what a ride it has been today. Right from picking up the right business structure to your company, to deciding about the design of the cap table, right from picking up the foreign investments to investment hygiene. We've also explored the areas of ESOP and compliance. There's a lot to learn in today's episode, sir. If you are a founder watching this video and podcast with us today, always remember that your startup is not just about your product. It's about building that in the right platform and using the right tools and guidance that we are providing. You're also making sure that you're having investor readiness, you're having compliances on top of the game, and also staying vigilant at all times. This is what separates a serious startups from the rest of the other startups which is already out there in the market. A big shout out and thank you for our guests, Prem sir, to breaking down this complex topics into clearer and more concise one, which is helping them. Thank you for helping me taking this information to our viewers and founders and to everyone who's watching this video today, sir. We'll meet you in such another interesting episode. Until then, ideate, evolve, and also keep building smart and stay curious. Thank you so much.